3 undervalued stocks to buy right now in October 2020. Let's get right into it. So the first stock we're going to be talking about is Marlin Business Services. And Marlin is a business development company. So what these types of companies do is they lend to small businesses to help them get the financing they need. So a lot of small businesses, it's harder for them to get funding to grow compared to larger companies. So that's where business development companies like Marlin step in and say, we will lend to small companies out there to help them grow and to help them meet their needs. So we're on their website right now. You can see Marlin offers fast and flexible lending solutions built for small businesses. They're a lending partner that works with small businesses, seeing behind the numbers to give business owners what they need to keep growing. Now we're going to take a look on FinViz, and Marlin is a company that got absolutely hammered back in March during the stock market crash, where we saw the stock go from around $20, it fell all the way to $6. And ever since then, it hasn't really recovered much. It's trading at around 760 right now, but it's mostly just been in this tight range since we saw the big drop. And if you look at the fundamentals, I think this company is still in a very sound position, where now you have the value, the forward PE is only a 5, and they're projected to be profitable next year. So even though this year they lost a ton of money, assuming the economy continues to get back on track, business lenders like Marlin should be able to become profitable again in the short term. Another thing about this company is they pay a 7.6% dividend. So business development companies are required to pay out a portion of their earnings in dividends. And so that's why most of them have a pretty large dividend yield. And so that plays into why Marlin has a 7.6% dividend. The price to free cash flow ratio is under a 2. So that just points to, if this company recovers and gets back to where it was before the pandemic, this company has a ton of upside. Another thing I want to point out, just to show how undervalued this company is, if you look at their enterprise value to EBITDA, again, that's what you could buy the whole company for. Over the most basic form of their earnings, it's a 0.5, and that is one of the lowest you're going to find anywhere. And so this is basically saying if you buy the entire company, you would make all of your money back in half a year. And now I'm not saying that's going to happen. These are based on the past 12 months earnings, and that is likely to be different than the next 12 months. But like I said, if we do see earnings of this company recover, this is an extremely cheap valuation that we have rarely seen with this company. And just to point that out, we're going to take a look at what their earnings and earnings per share valuation looks like. So here are the earnings per share, and since 2010, we have the great financial crisis, and since then this company has done very well, where we just see earnings per share consistently going up, and we did see the drop off, and in the past year they have lost money, as have most companies out there, especially small business lenders. And if you look at the valuation, most of the time this company, which trades around 10 times earnings, I would say that is a conservative valuation for this company. And right now they're at $7. So if we do see them return to that 10 times earnings on normalized earnings, if the economy recovers, we could see the stock trade up to around $20 per share. In terms of their financial health, this company does have a relatively strong balance sheet. They have more cash than debt. So that is the biggest problem out of the way right there. Most business development companies are loaded up on debt. And while they do have some, they have more cash than debt. So that is a big plus for this company. It's no surprise that based on any type of valuation of this company, this is the cheapest it's been in a long time. Another good chart is this chart showing the revenue growing very nicely, and we can take a look at net income, again, also growing very nicely. So this is obviously a very well-run business. The question just is, will the economy recover? And I think a big reason that this stock got hammered so much is because of their involvement with small businesses. With the economy where it is right now, it's no surprise that small businesses are the ones that are hurting the most compared to large corporations. And so because of this, it always is a risk that those small businesses will continue to suffer, and a lot of the companies that Marlin gives loans to won't be able to pay the loans back and will default. And in that case, that would be a very bad thing for Marlin. So I think the initial sell-off was justified, seeing how much trouble small businesses are in right now. But if we do see the economy begin to recover, this is a stock that could see a lot of upside in the next 3 to 5 years. All right, the next stock we're going to look at is Marcus Corporation, and this is more of a turnaround play, where Marcus Corporation is the 4th largest movie theater chain in the United States. They also operate a number of hotels and restaurants. So this obviously is a part of the economy that is suffering a ton right now, mostly because movie theaters have been closed for the past few months. And I'm not even sure if they're still open yet. I think one movie theater chain opened their theaters and then decided to close them down again. So it's still very unclear when these movie theaters are actually going to be able to open permanently. And even once they do open, how many people are actually going to show up to watch movies again. Now, if you take a look at this company, the stock price has performed very well since from 2010 to around 2019. Where we saw coming out of the great financial crisis, the stock did extremely well, going from $10 to over $45 a share. And then we've seen that crash all the way down to back under $10 a share at $7.47. This is the same price that you could have bought the stock back in 2008, 2009 at the bottom of the great financial crisis. So if you do think this company will recover and the movie theater industry will recover as well, then there is massive upside with this stock. Now, the thing I like most about this company compared to the other movie theater chains like AMC is that this company is a lot less leveraged and has a much healthier balance sheet than those other movie theater operators. Their debt to equity is only a 0.65, and even though this company still has a lot of debt, it is not nearly as much as the other movie theater chains out there. Now, if you look at their net income, it's performed very well over the past decade. And if you take a look at revenue, again, very good growth on the top line as well. And so again, the main concern with this company is just their health. Their current ratio is a 0.77. So even though that's not ideal having it under 1, that doesn't mean that this company is going to go out of business next month. They do still have a lot of financing options out there, and I think they just secured a loan to get them through the next period of a few months to a year, where movie theaters might still not be open consistently. And another thing I like about this company a lot is that they own most of the underlying real estate in their movie theaters, hotels, and restaurants. So unlike other movie theater chains like AMC, which mostly lease out the movie theaters, Marcus Corp actually owns the real estate of the movie theaters, which I think is a big upside to this company. That gives them more options in terms of financing in the short term, where they could put up that real estate as collateral to take on more debt, or in the worst case of a liquidation, they would be getting something for that real estate. So again, this is a recovery play. If you do think movie theaters will recover, then I think there's a ton of upside for the stock, and we could see the stock go back to at least $30 a share or more. All right, for the last stock in this video, we're going to be talking about First Internet Bank. And this is a bank that's been around for a while. They are a completely online bank, much like Ally Bank, or there's a few others out there. An advantage for this bank is that they have higher interest rates for their accounts. Their money market is 0.7%, and that is because they are an online-only bank. So with most online banks, they are going to offer higher interest rates because they can keep their expenses low since they have no physical branches. Now, in terms of looking at the valuation of this company, there's a big drop in earnings in 2014, but since then the company has recovered well. And if you look at the PE ratio of this company, they are trading at one of the lowest valuations that you have seen, where I would say the normal PE is around a 10 for this company, and right now they're trading at under a 7 times earnings multiple, and that is similar to what we saw back in 2012, 2013. So this company is trading at a very depressed valuation. Again, if we do see the economy recover, and I'm someone that strongly believes that over the next 5 years, we will see interest rates start to normalize. And so in that environment, banks tend to do very well. Taking a look at their revenue growth, very consistent growth, again, since 2014. That is a very healthy sign to see. And income also having a nice increase. Another thing to notice is their book value is $34 per share, and right now they're trading at $16. So they're trading at under half their book value. That is probably the easiest way to value a bank. Just look at their book value and look at how price has been valued to that in the past. So seeing this in my mind, this stock should be able to double relatively quickly, especially if we see a recovery in the economy and we see interest rates start to go up to their historical averages. This company does pay a 1% dividend with only an 8% payout ratio, so this is a very safe dividend, and this has the potential to be a dividend growth stock. If they put a priority on growing that dividend, they have a ton of room to do it. With only an 8% payout ratio, they have a huge runway for growth on that dividend. So that's it for this video. Those are the 3 stocks that I think are a buy right now in October of 2020. As always, nothing in this video should be taken as financial advice. I'm merely presenting these stocks to you as ideas for you to go and research more on your own if you are interested in them. You should not buy a stock just based on watching this video, and always consult your financial advisor. So that's it for this video. If you like my stock picks, leave a thumbs up on this video. It helps out my channel a ton. And if this is your first time watching one of my videos, subscribe to the channel right now and hit the bell icon so you get notified whenever I upload a new video. So that's it for now, and I'll see you next time.